you, Joe, and thank you, ladies and gentlemen. A lot of oversights on my part at age 67. Note to self, never follow a dogfight between Johnson and Schiff. All you guys had a really good time, watched a wonderful dogfight, and now I have to come up and speak seriously about things. Terrible challenge. But I'll do my best to amuse you. And I think I'm going to be able to deliver value to you. Those of you who have schedules, programs, will see that my speech is something about bull markets. How many people here were at the private placement workshop? Reasonable number of you, so bear with me because I'm going to cover a little bit of the same ground. Many of you who have known me for years know that my thesis, or at least my slogan, is that in the resource business you are either a contrarian or you're going to be a victim. We have been through a bear market that's really truly one for the record books, the ugliest one that I remember being through since the middle part of the decade of the 80s. And in my experience, bear markets have been the authors of bull markets. If that's true, the bear market that we have been through could be the author of an extraordinary bull market. I've learned over time that you can describe these things forever and never get anywhere, but if you leave people slogans, they remember what you're trying to say. So this reminds me of a bumper sticker that I saw in Midland, Texas some years ago. After their great decline in the middle part of the 80s, the bumper sticker said, "God, give me one more bull market. I promise not to waste this one." So I want to talk to you about bull market activities and bear market activities. But I guess first what I'd like to do is establish that, at least from my point of view, we're in a bull market, at least in precious metals and perhaps later in precious metals equities. And what's that mean? I will draw your attention to a chart that if you're a Sprott client, you have seen, the Barron's Gold Mining Index chart. It's a 40-year chart of gold equities markets. I use the index not because it's better than anybody else's index, but simply because it's the longest running chart that I see. And what you see on this chart brings up several points that I think are relevant to you. By the way, if you haven't seen the chart and you email me, and I'll give you my email address at the end of the presentation, I'll certainly send it to you. The chart shows just how wildly cyclical gold stocks, as represented by the index, are. Individual stocks, of course, are even more cyclical than the index itself, but we'll stick to the index. There have been 8 oversold bottoms, 9 oversold bottoms, and 9 recoveries. And the recoveries are particularly interesting if you believe, like I do, that we're in the early stages of a gold bull market. They're also interesting if you don't believe that, because the truth is that what you will see in terms of where we are now relative to historic valuations over 40 years is that if we aren't up off the bottom, we aren't at the bottom, if we're only approaching the bottom, that the recoveries, if the recovery that we experience this time rivals any of the last 9 recoveries, are so dramatic that waiting for an absolute bottom or resenting missing an absolute bottom is a waste of time. In 9 prior recoveries, the worst recovery took 17 months and generated 180% index gain. The best recovery took 46 months and generated a 1,200% index gain. So the point of this chart is really threefold. The first is that we are at, approaching, or just off a bottom. The second is that the recoveries coming off these bottoms are really, truly spectacular. And I want to set the circumstance with that. That's the narrative, if you will. It's the justification for what follows. What's behind the narrative? Let's look at gold. Let's set the stage. I talked about this a bit yesterday, and other people have probably beat it to death, but I'm going to make you suffer through it one more time before you get to the panel. In my own experience, gold bullion, while it responds to many factors, responds most particularly to a lack of faith in the ongoing purchasing power of various fiat currencies over time, the most important fiat currencies being the world's reserve currency, which right now is the US dollar. And more particularly, gold responds to real interest rates. That is, the interest rate after the depreciation of the currency. The value proposition offered up by US dollars, as referenced by the US 10-year Treasury, is about 180, 186 basis point yield in a currency that the Congressional Budget Office suggests is depreciating by 1.6% a year. In other words, if you entrust your money to the US government, they promise to give you a 20 basis point real yield over 10 years. My friend Jim Grant has described this risk to reward equation as return-free risk. So I would suggest to you that the primary rival for gold in investors' favor is the investment proposition of return-free risk. If you think about that, it's not a very attractive proposition, but I think it gets worse. I'm a credit analyst, and when you look beyond the yield to the quality of the credit, what you see is interesting. You see the strongest reserve currency in the world, and you see that it's perhaps not as strong as you hope it was. Strong, yes, compared to the yuan, compared perhaps to the renminbi, compared to the euro, but absolutely strong. Now, that's another question. Let's look at the balance sheet. $22 trillion in recourse liabilities, offset by $5 trillion in assets. So $17 trillion upside down. I'm looking at the lady in front of me, and her eyes are impassive. $1 trillion doesn't make sense to her. I say $17 trillion, and she thinks of 17 with 12 zeros behind it. She doesn't think about the magnitude of that number. But it gets worse. That $17 trillion is on balance sheet liabilities. That's money that we acknowledge that we owe to each other. The off-balance sheet liabilities, that is promises that we've made to each other, exceed, according to the Congressional Budget Office, $100 trillion. So in the United States, and by the way, Canadians aren't immune, the Ontario balance sheet is worse. On balance sheet and off balance sheet, we owe $120 trillion in the US. Our former president said it didn't matter because we owe it to each other. Well, that's not true. The spenders owe it to the savers. In a democracy, the spenders are more numerous than the savers. So you know that old joke about a democratic process is 4 coyotes and a lamb voting over what's for lunch. The lamb are the savers, which suggests that there's some risk with regards to that $120 trillion obligation. But it gets worse. That obligation doesn't include state and local debts. Conrad Black did a wonderful job of Canadianizing that equation yesterday. And of course, it gets worse from there in that it doesn't include underfunded pension funds. I didn't bring you here to drive you to drink, but I'm going to do one more job of making you sick before I make you well. We service this debt, of course, in the United States with the national income. That is taxes and fees minus expenses. The problem is that the national income is a $1.4 trillion deficit, which is to say the national income that we use to service the national debt increases rather than decreases the national debt. I realize that with things like modern monetary theory, long way of saying counterfeiting, that we're in the era of new math, but I challenge anyone, including any politician, to explain to me how you add a column of negative numbers and come up with a positive sum. I tell you this not merely to amuse you, but to say that my assertion that we're in a gold bull market, I would suggest is based up, rather than with narrative, by arithmetic. That arithmetic being the debt and the ability to service that debt. From my own point of view, the only way you service that debt is one, a good old-fashioned default. That is the US saying to the bondholders, too bad, so sad, times are tough, screw you, you're not going to get paid. And of course, the younger generation saying to my generation, yes, you've voted yourself all these entitlements, you pay for them, we ain't going to pay. Highly unlikely, I suspect, to take care of. I think in the interim, we service that by printing. We service it by modern monetary theory. We service it by quantitative easing, which is a different way of saying counterfeiting, or a different way of saying we are going to continue to debase the currency. That could be okay, I guess, if we allowed interest rates to rise, but we can't afford to allow interest rates to rise because the debt service goes up and the stock market tanks. My suspicion is that the writing is on the wall for gold and that many, many, many people see it. And if the bullion continues to do well, I think the stocks continue to do well too. A larger bull market may be coming over time. There is a different chart, which I'm also happy to send you, which is a 100-year commodity chart, which suggests that commodities measured against other indexes, including currencies and including equities, are at a 100-year low. My suspicion is that a recovery in general commodities might be a bit delayed by economic weakness. But the truth is that I think that we are coming out of a bear market in gold into a bull market in gold, and ultimately we will come out of a commodity bear market into a commodity bull market. Many of you in this city have recognized the busts and the booms associated with commodity cycles. And it's my suggestion that we are in the early innings of a gold bull market, which will be followed eventually by a commodities bull market, and that bull market will extend ultimately towards the speculative stocks that built this conference. What do we know historically about gold bull markets or precious metals bull markets and how to play them? We know that historically, gold has moved first against skepticism. It has, quote, climbed a wall of worry, which is precisely what gold is doing now. You've seen no spike in the market. You've seen slow, steady increases with lots of declines and lots of recoveries. Perfect, perfect, perfect market. You also know that in a gold bull market, at least historically, that the best of the best have risen first. And there's a great reason for this. In fact, two reasons. One reason is that with the beta in the market, that is, with a market that recovers to 180% gain in a weak recovery and a 1,200% gain in a good recovery, one doesn't need to outperform the market. One doesn't actually need to generate alpha against a market that gives you between 180 and 1,200% gains. If you just capture the gain, if you just capture the beta, or better yet, de-risk the beta by owning the best of the best names, you have great risk-adjusted returns. The other thing is that when generalist money comes into the gold space, it goes into the biggest, the best, the highest margin, the most valuable names, the Francos and the Barricks of the world. They move first, they don't move the furthest, and that's precisely what we've seen. The high-quality golds have done well. One thing that we're seeing in this market, which I think we'll continue to see, is we're beginning to see mergers and acquisitions. Remember, in the market that we're in, increasingly it's machine traded, as Frank Holmes has pointed out so well. Bigger companies have more liquidity, they have a lower cost of capital. In the capital-intensive business, the guy with the lowest cost of capital wins. So beyond the move that we've seen in the major mining companies, which has been a great move, we've seen wonderful returns to mergers and acquisitions, which we at Sprott continue to believe that we'll see. Normally, a gold bull market is followed midway through by the beginnings of a silver bull market. Gold leads, silver follows. Silver moves faster and further than gold does for various reasons. Its volatility, its low unit cost. And the asset class, which traditionally has been the most volatile, both to the upside and the downside, are the silver equities, in particular the high-quality silver equities. So I would suggest to you in a very broad sense in terms of this market, first of all, if you think the gold price is going up, which I do, buy some gold. There's a reason to own it. That reason, from my point of view, is insurance. The second thing is, in terms of participating in this gold market, buy the best to begin with. Make sure that you capture the beta, because the beta itself is extraordinary. One really nice thing about the metals markets is that the best of the best can give you penny stock returns over decent periods of time with much less than penny stock risks. I'm not saying, by the way, don't speculate. I'm saying invest before you speculate. And when you speculate, focus yourself on the very best people and the very best prospects. The truth is, particularly in a city like Vancouver, where there's 1,000 or 1,200 issuers, and where everybody at the golf course is fantasizing over a 6-cent stock that goes to 36 cents, we tend to go from speculative to preposterous to absurd. And there's no particular reason to do that. I know that all of us, myself included, did it in 2011, 2012, and we were rightly spanked in the period 2012 forward. Remember that a bear market takes away everything that a bull market gave and more. There's no particular reason that any of us, myself included, repeat our past mistakes. All we need to do is remember back to our actions in the last bull market, and we need to remember the actions that made us money and the actions that lost us money. We need to remember, despite the ebullience that we may feel in a bull market, the dejection that we felt in a bear market, and I think we need to avoid the activities that caused us so much problem. You know, as investors now, we're given so many wonderful tools. One tool that's available to me simply is my own memory. Having been in this business for 40 years, I know the people who have made me look smart. I know the people who have made me look stupid. Sadly, the people who made me look stupid outnumber the people who have made me look smart, but there's no particular reason why I would have to return to them other than some desire to be spanked, which I do not have. In this city, you can rub shoulders with both the smart people and the stupid people as often as you want. But the truth is that there is a group of people in town that have been serially successful. They have names too: Beatty, Quartermain, Lundin. You know all these people. They're accessible to you. There's a second generation, and you know them too. The best people, the best prospects make you the most money. No, you can't buy the best people for 6 cents. You might have to pay up. You might have to pay 60 cents or 70 cents. But the truth is, when you speculate, the best people with the best prospects make the best money. Chasing the silly stuff always, from my point of view, ends in tears. The second tool that we have available to us, other than proximity in our memory, is that there's a wonderful amount of data in the market. If you employ common sense and look at publicly available data, you can cause most of the bull market sins that you commit to go away. Look at the company's balance sheet, look at the company's income statement. Many companies on the TSXV are spending 50, 60, or 70% of total capital raised in general and administrative expenditures. What's the probability of making an exploration success if 35% of the money that you raise goes in the ground? It's difficult enough in the industry to make discoveries when 85 cents goes in the ground. It's practically impossible, other than a stroke of luck or God's interference, to make money putting 35 cents in the ground. And this is available to you. This is publicly available to you. So often, when clients, new clients to Sprott send in a laundry list of stocks, there'll be 40 or 50 stocks on the list. And when I talk the clients through why they own the positions, the truth is that they don't know. And a stock that you don't know is a stock that's really, truly set up to punish you. So I would suggest that the best defense in a bull market to protect you from what will certainly afflict you in a bear market is simply the application of common sense and the application of a little work. I'm going to do something I've never done at this conference before, and I'm going to give you an incentive to review your own portfolios, which I really think people ought to do on a consistent basis. I'm going to do something more too. In terms of the speculative part of your portfolios, almost all of you own too many stocks. I ask clients, people say, well, what's the ideal portfolio? Is it 10 stocks or 15 stocks or 50 stocks? I like to tell people that they should own the number of stocks that corresponds with the number of hours per month that they're prepared to spend on the portfolios. I'd like you to call the companies. I'd like you to read the 43101s. I'd like you to read the income statements. I'd like you to read the balance sheets. I'd like you to read the proxies. In other words, I'd like you to know something about the companies that you invest and speculate in. So I'd like to help you build a baseline. Everybody have their pens, paper, pencils out? I want you to do this now. Anybody who wants, if you email me at rankings, R-A-N-K-I-N-G-S, rankings@sprottglobal.com. If you give me a list of the stocks, resource stocks in your portfolio, I will rank the stocks, at least the ones I know, 1 to 10. 1 being the strongest possible buy, 10 being take out a second mortgage to short it. And where appropriate, I will add comments on those stocks. That is where I think my comments are appropriate. In addition, if you say and by the way, in the text of the email, not as an attachment, which my computer people won't let me open, I want the names and the symbols. If you gave me the names and the symbols in the text, I'll send you back these rankings. I will also send you, if you want, if you say charts, both the Barron's 40-year gold mining index chart and also the 100-year commodity chart. In sum, I want to leave this with you. We have truly been through an epic bear market. If, as in my prior experience, a bear market is the author of a bull market, we could be in for an extraordinary bull market. But whether or not you participate fully in that bull market, whether or not you maximize the return, is not up to the market, it's up to you. I hope that you will utilize common sense and some of the tools that I've been giving you, and that you will, in the words of that bumper sticker in Midland, Texas, enjoy this bull market rather than wasting it. Thank you, ladies and gentlemen. It's been a pleasure being in front of you.